Chapter 8 The Efficient Market Hypothesis. We're going to look at whether market is efficient, and we are going to introduce some empirical tests as well. Before introducing the efficient market hypothesis, I want to introduce the theory of random walk. Random walk means the stock price changes are random. No one can predict the stock price pattern in the future at all. The efficient market hypothesis is one of the most important hypotheses in the modern finance theory. It says the prices of securities fully reflect available information. It means the current level of price already incorporates all available information in the market. So, based on all available information currently, you can never predict the stock patterns in the future. The logic behind the efficient market is competition. Competition is the source of efficiency in the market. Information on the market is the most precious commodity on Wall Street because if you can get information 1 minute faster than other investors, you can use that information to make great profits. So the investors are all very motivated to gather information so that you can get a higher investment returns. So the competition among investors to gather information is fierce, and this high competition should imply the stock prices reflect all available information. So for individual investors, the marginal return on doing actual research on stocks may be so small, and only managers of largest portfolios will find them worth pursuing. Let's take a closer look at the efficient market hypothesis. It says prices reflect all available information. It takes 3 different forms: weak form, semi-strong form, and strong form. The weak form says prices reflect past information. Here, past information means past prices and past trading volume information. Technical analysis using past price patterns and past trading volume patterns will not make money under the weak form of market efficiency. Semi-strong form. Prices reflect all public information. Here, all public information means fundamentals, earnings forecast, income statements, balance sheets, cash flow statements, all the public informations in the market. So fundamental analysis based on all public information will not make money under the semi-strong form. Finally, we have the strong form. Prices reflect all information. So here, all information means all the past price, trading volume, all publicly available information, and insider information. All possible information is going to be reflected in the asset prices. If you look at the picture, the information set, weak form information set, is the smallest one. It only includes past price and past trading volume information. Semi-strong form information is a lot bigger. It includes the past price and trading volume information, but it also includes all public information like balance sheets, income statements, cash flow statements, all fundamentals, earning forecast, earning costs, all publicly available information. The strong form set information is the biggest one. It includes both weak form information, semi-strong form information, and insider information as well. The technical analysis uses prices and trading volume information to predict the future prices. So for technical analysis, you don't need any other information. All the information you need is the past price and the trading volume, and you try to identify the pattern in the past and use that past pattern to predict the future price pattern. If the stock price responds to news slowly enough, then the analyst will be able to identify a trend, and that trend can last for a while for you to make a profit. So the key to the successful technical analysis is a sluggish response of stock price to the fundamentally supply and demand factor. If the technical analysis can make any profits, that is to the opposite of the notion of an efficient market. Here in this picture, I provide you a very common technical analysis pattern. A lot of the people trading based on technical signals. For example, the moving average is the most popular technical analysis signals people look at. So in this picture, you can see the black curves are the daily trading price of a stock. And then you calculate some moving average of the stock. You can use the past 30 days, past 6 months, past 200 days. Depends on your preference. Let's say if you calculate the moving average price based on the past 30 days stock price, okay? Then you will draw the blue line, which is a lot smoother in this trend, in this picture. Okay, so whenever the close price is higher than the past 30 days moving average price, that is a buy signal, because today the price is higher than the average of the past 30 days. This is a upward trending. So you want to have a free ride in this upward trending. So that is your signal to buy. For the sell signals, if the current close price is lower than the past 30 days moving average price, which means today's price is lower than the previous 30 days average return, then this predicts a downward trend in the future. You want to sell the stocks to avoid the loss. Okay? So the use of the technical analysis is very subjective. In this example, we use the 30-day moving average price. But some people prefer to use 200 moving average price, means you calculate average price over the past 200 days. Which one is right? Which one is wrong? There is no right or wrong answer in technical analysis. It really depends on personal preferences. So basically, technical analysis is a rule of thumb. Here I present another picture of the popular technical analysis. We look at the left-hand side picture first. Here we see an upward flag. So the purple area looks like an upward flag. When the price level drops below the bottom of an upward flag, most of the time the downward trending will begin. When you look at the right-hand side picture, you see the purple area. This is a downward flag. When the price level breaks the top of a downward flag, then most of the time the upward trending will begin. There are hundreds and thousands of different technical analysis signals. If you are really interested in technical analysis, I uploaded a supplementary reading on technical analysis on the Blackboard for your reference. You're welcome to read that. Fundamental analysis most of the time will do research on determinants of the stock value. They try to find factors that can predict the future stock returns. Those factors include earnings, dividends, future interest rate, and firm risk. A very popular fundamental analysis model is called discounted value model. In this model, financial analysts will try to forecast, estimate the future cash flows of the company, and then he will calculate discounted value of all future cash flows. If the discounted value is below the current market price of the stock, means the stock is overvalued. This is a sell signal or short sell signal. If the discounted value is higher than the current market price, then this is a buy signal, means the stock is currently underpriced. The trick here is you have to fund the undervalued companies faster than other investors. Now we have known what is technical analysis and what is fundamental analysis. Let me summarize one more time. If technical analysis can make profits, can predict the future prices, that is a direct violation to the weak form market efficiency. If you can use fundamental analysis to predict the stock price and make a profit, that is a direct violation to the semi-strong form market efficiency. If the market is truly efficient, means the active management trying to do security analysis and time the market will not generate abnormal returns. Passive management is the way to go, means you buy and hold a well-diversified portfolio without attempting to fund mispriced securities at all. All you have to do is buy an index fund, say S&P 500, which is a proxy of a well-diversified market portfolio. So the question is, if the market is efficient and everybody is holding an index fund, say S&P 500 index fund, do we still need portfolio management? Well, the answer is yes. Even the market is efficient, there is still role exists for the portfolio management. Here, the portfolio manager will help you to achieve the goal of diversification. They can evaluate your risk level, tell you what is the percentage you should put in the risk-free asset and what is the percentage you want to put in the risky S&P 500 market index. And also they will help you to design the portfolio to maximally avoid tax payments. So the role of the portfolio manager in an efficient market is to tailor the portfolio to those needs rather than to fund abnormal returns and beat the markets. Now we have known the basic idea of the market efficiency. Let's do some test and test in real life whether the market is efficient or not. We're going to test the weak form market efficiency first. If we can just use past price and trading volume information to predict the future, then the weak form market efficiency will not hold. The empirical studies by the finance scholars found momentum effects in the short-run horizons. Short-run horizons means the time period is below 1 year, say 3 months, 6 months, 9 months, and a year, up to a year. Momentum effect says the poorly performed stocks will continue to perform poorly in the future. The well-performed stocks will continue to perform well in the future. For example, if you look at the past 3 months return, if the stock is performed really badly, then for the next 3 months in the future, it will continue to perform badly. If you look at another stock, over the past 3 months, it performed really well, then there is a tendency for that stock to continue perform really well in the future 3 months. Based on the momentum effects, we can design a portfolio that buy the past winner stocks and sell or short sell the past loser stocks, and we can generate abnormal performance in the future periods. So the momentum effects shows the weak form market efficiency does not hold in reality. When we look at the longer horizons, means longer than a year, we found reversal effects in empirical studies, which is the tendency of past loser stocks will perform better in the future, while the past winner stocks will perform badly in the future, you see these reversal effects. The long-term horizon, most of the time we are looking at 3 years, 5 years, 10 years, even longer periods. So as long as you wait long enough, the past losers will become future winners, and the past winners will reverse and become future losers. Based on the reversal effect, we can simply design a portfolio, buy the past losers and sell or short sell the past winners and hold it for a long period of time, and we can generate abnormal returns. This is a direct violation of the weak form market efficiency because we are purely using the past price patterns, the past return patterns to predict the future. Again, in reality, the weak form market efficiency does not hold. In this section, we are going to test the semi-strong form market efficiency. We are going to do a lot of very interesting tests in the empirical analysis. So first of all, I want to introduce the idea of anomalies. What is anomalies? Anomalies are abnormal returns that contradict the efficient market hypothesis. The first test in the semi-strong form test is the PE effects. Empirical study shows the portfolios of low PE stocks have higher average risk-adjusted returns than the high PE stocks in the future. PE ratios are public information. You can find it on any financial website. So they are free information, public information. Based on the PE effect, we can design a portfolio that buys low PE stocks and sell or short sell high PE stocks. In this way, we can generate abnormal return. This is a direct contradiction to the market efficiency because according to the semi-strong form market efficiency, you cannot use public information to generate abnormal return, while PE ratio is public information, and we can design our portfolio to gain abnormal returns in the future. So the PE effects shows the semi-strong form market efficiency does not hold in reality. The second test is called small form effect. It is very famous. Recall our three-factor models, Farmer-French three-factor models. One of the factor is based on the form size, which is exactly empirical results here. So the small form effects shows the stocks of small forms can earn abnormal returns, especially in January. If you look at the picture, the empirical analysis here is we are going to group all the public traded stocks into 10 decile, means 10 groups. Decile 1 are the 10 bottom smallest stocks. Decile 10 are the top 10% largest stocks based on the market capitalization or the size of the company. And we calculate two different returns. The pink one is the average return in excess of the risk-free rates. The black one is the return in excess of the campaign model. It doesn't really matter what return we are using. You can see decile 1, the smallest stocks, always deliver higher return than decile 10, the largest stocks. Based on the small form effects, we can build a portfolio buying decile 1, the smallest stocks, and selling decile 10, the largest stocks, and we can earn abnormal returns. That is, again, a direct contradiction to the semi-strong form market efficiency. The third test is called neglected form effects. The stocks of very little known forms can generate abnormal returns. If no one pays attention to those forms, the information of those forms will not be incorporated in the current market price on a timely fashion. So maybe you can generate some abnormal returns since nobody else is paying attention to that stock. The fourth test is again a very famous test. It's called book-to-market effects. Remember the Farmer-French three-factor models we introduced in the previous chapter. The last factor, the third factor, is the book-to-market factor, right? So basically it says stocks of high book-to-market ratios will generate higher return than low book-to-market ratio stocks. So if you look at the picture here, again, we group all the forms into 10 deciles, means 10 groups, based on the book-to-market ratios. Decile 1 has the lowest book-to-market ratio. Decile 10 has the highest book-to-market ratio. As you can see, the average monthly return for the decile 10 or the high book-to-market ratio stocks always generate higher return than decile 1 or the lowest book-to-market ratio stocks. Based on the book-to-market effects, we can build a portfolio buying decile 10 stocks and selling decile 1 stocks, and we can generate abnormal returns. Again, this is a direct violation of the semi-strong form market efficiency. The fifth test is called the post-earning announcement price drift. It is a very important research question, and we have a huge literature studying the same subject. So basically, if you look at the picture, on the horizontal line, time 0 is the event day, is the date the earning announcement is made. Public traded firms have to announce the actual earnings per share after each quarter end. Before the actual announcement of the earning is made, many analysts who follow the form will make estimations. Like for example, at the end of the year, the company A made an earning announcement. Each share it had $2 earning. So the EPS, the earnings per share, actual number is $2 based on the announcement. So this announcement is made on day 0. But before the company actually announced the $2 earnings per share, analysts who follow the form will give predictions. For example, 10 analysts following the company, they will give out 10 estimation numbers before the actual announcement date. Maybe very optimistic analyst will estimate $5 earnings per share. More pessimistic one will give, say, $1 or even negative numbers earnings per share. So the expected or the average or the market consensus of the earnings per share is the average of the 10 analyst estimation. If the average estimation is, say, $3, which is higher than the $2 actually announced number, then we say there is a negative surprise because people's expectation on average $3 per share, but the actual announced number is $2, which means on the announcement date, the stock price will drop because the company didn't meet the market expectation. If the average earning announcement estimation number is, say, $1, the estimation number $1 is lower than the actual announced $2, then we say there is a positive earning surprise because the market consensus or the average of all analyst estimation is only $1, but the actual announced number is so much better. So there is a positive earning announcement. If the earning surprise is positive, on day 0, when the company made the actual announcement, we will see a price jump because this is a positive, unexpected positive news. If we group the stocks into 10 deciles, with decile 10 the top 10% with the highest positive earnings surprise, decile 1 are the stocks in the bottom 10% most negative earnings surprise. You can see after the day 0, the event day, or the actual earning announcement date. Decile 10, or the positive earning announcement stocks, will continue have a positive upward drift, so the price will continue to go up in the following up to 90 days period. For the Decile 1, the most negative earning announcement stocks, the stock price will continue to drop until the day 90 days after the actual earning announcements. So the drifts here are called post-earning announcement drifts. Based on this finding, people can easily form portfolios on day 0 when the actual earning announcement is made. Then people will buy the most positive earnings surprise stocks and sell the most negative earnings surprise stocks. Forming this portfolio will continue to generate abnormal return at least up to 90 days after the actual earning announcement date. So the existence of post-earning announcement drift is a direct violation of the semi-strong for market efficiency. Here is a real-life example of the earning announcement surprise. On February 7, 2018, Twitter announced better than expected earnings. The actual announced number is 19 cents per share, but the expected number is only 14 cents per share. Again, the expected earnings are the average of all analysts following the Twitters, their expected numbers. So you add them up and divide it by the total number of analysts to calculate the average or the expected earnings across all different analysts who following Twitter stocks. So this is a positive earnings surprise. The stock price jumped from $27 to $33 immediately in one day, which is a 22% increase. Now here is the example of negative earnings surprise. UBNT announced earnings on February 8, 2018. Pre-market means before the market opens. The expected earning is 89 cents per share, means the average of all analyst estimation number is 89 cents, but the actual announced number is only 76 cents. So this is a negative surprise. The stock price dropped from $78 to $67 in one day immediately. That is 14% decrease. Finally, I want to talk about the bubbles and market efficiency. According to the market efficiency, if the stock price is above or below the true value, people will start trading on the stock. The trading itself will bring back the stock to the true intrinsic value. For example, if the true value of the stock is $100 and current market price is $150, it's way too high. In the market efficiency hypothesis, people will start shorting the stocks. Shorting the stocks will drive the stock price down, because if everybody start to sell the stocks, you have a huge pressure to push down the stock price, and then push down the stock price from $150 to $100, the intrinsic value or the true value. But in reality, the bubbles can raise the stock price above the true value, but it's very difficult to take advantage of this inaccurate price estimation. Go back to our previous example. Even if you know the stock true value is only $100, now the current market price is $150. But the problem is you are the only few rational investors. If there are other crazy investors out there still crazily buying the stocks, think the stock price will go up to $200, $300. Those are irrational expectations, But the majority of the investors in the market are in that trend. They truly believe the stock will go up to $300, $400, $500. So other investors are still buying the stock. They can drive the stock price from 150 current price to $200, $300, even $500. If you start a short position at $150 while the market is moving to $200, $300, $500, you will broke very soon, because in the previous chapter we know when you short a position you have to put margin, means you own money in the account. If the stock price continue to go up, you have to continue to put money out of your pocket in the margin account. It cannot last very long. Before you know it, you broke. Okay, so suppose when the stock price goes up to $500 and you short the stock at $150, you broke. You're totally out of the picture. But then at that point, people finally calm down and found, oh wow, the true value of the stock is actually indeed just $100. Then people start selling the stocks. Okay, even if you were right at the very beginning, you knew the true value of the stock is $100, but you start the short position at $150 and you broke when the stock price go up to $500. At that point, you already broke. So even the stock price go from $500 back to the intrinsic value of $100, you have no position anymore. So it's very difficult in reality to take advantage of the inaccurate price. Or in other words, it's very difficult to take advantage of bubble because shorting the asset price is very expensive. Finally, we are going to test the strong form market efficiency. Strong form says the security prices reflect all information, public and private information. Strong form has the biggest information set. It incorporates the weak and semi-strong form efficiency information. So basically, the strong form says anything related to the stock are known to at least one investor. So that information is already incorporated in the securities price. So a couple of more words about inside information. The stock price will rise after insiders buy shares and fall after insiders sell shares, because the market think the insiders have superior information about the firm's prospects. So for example, if stock X beat the market expectation when it made the earnings announcement, okay, there's a positive earnings surprise. The stock price will rise from $52 to $55 after the earnings announcement. Now suppose you were the insider of the company. You knew this information, this positive earning announcement before it reached the public. You will make a lot of money. But the problem is insider trading is illegal. If you actually trade on insider information, they can put you into prison. So therefore, we do not expect all available information to be embedded in the stock price. So we have showed so many empirical studies that prove the market is not really efficient. So the final question is, again, are market efficient? Well, in academia, we have two groups of people. The first group of people, leading by Farmer and French, they believe even though those abnormal returns are presented in the literature, the market is still efficient because those superior returns can be explained by the risk premium. For example, empirically we show the small stocks have higher return than big stocks. According to Farmer and French, the higher return from the smaller stocks because they are riskier. So you are just getting compensated for taking a higher risk. So the second group of scholars by LSV, They believe the market is not efficient because empirically people have shown you could earn abnormal returns by investing in smaller stocks, in high book-to-market value stocks, by forming portfolios according to the earning announcement, positive or negative surprise, right? So the market is indeed not efficient. So basically we have two groups of scholars. One group insists the market is efficient. You're getting higher return because you are taking higher risk. The second group of scholars think the market is not efficient. So which one is right? There is not right or wrong answer to this question at all. Both sides have their own reasons and logics. So as to each one of you, as a student, as a scholar, you can have your own belief. You can believe market is efficient, or you can simply think the market is not that efficient, at least in the short run period. So there is no right or wrong answer to this question at all.